The October CPI. Electrical noise is far from static. The ABS released the new complete monthly CPI, which came in broadly as we expected, but it was stronger than what the market had anticipated. Due to a stronger than market expected print, we have seen some shift in the outlook for inflation and expectations around the RBA. But we at Westpac have taken a different view. Now, why is that? Let's break it down. The monthly CPI gained 3.8% in the year to October. That's just a touch softer than our estimate of 3.9, but quite a bit stronger than the market's expectation of 3.6. So, while some commentators were surprised, this result was broadly within our expectations. There was the static noise from electricity rebates ending, and we've seen the annual pace lift from 3.2% in August to 3.6% in September, and now 3.8%. In the month, the CPI was flat, which is a little softer than our nearcast of 0.1%. Why? There was a much larger than expected fall in electricity prices, down 10.2%, with the next round of rebates in New South Wales and the ACT to be only partially offset by a smaller decline in auto fuel and an unexpected bump in garments, particularly for male and female garments. The ABS also released a new improved version of the core measure, the monthly trim mean. This measure increased 3.3% over the year to October, up from 3.2% in September. On a monthly basis, it rose 0.3%, the same increase we've seen for the past 2 months. That is down from the 0.5% jump in July, but stronger than the softer prints earlier in the year. Now, it's important to note the RBA still focuses on the quarterly trim mean, and we expect that to continue, even with the move to the complete monthly CPI. Why? Because the ABS doesn't yet have enough history to fully seasonally adjust all the components of the CPI. They estimate it'll take at least 18 months to build that data set. So what does this mean for the December quarter CPI and the December quarter trim mean? We have a lot more work to do with the new monthly series, so this point of view may change, but our preliminary view suggests some modest downside risk to our headline estimate of 0.6% in the quarter, but a lot will depend on how much electricity prices recover in November and December. For the trim mean, we're holding our estimate at 0.7% in the quarter, which would lift the annual pace slightly to 3.1% from 3%. We still believe the September bump was temporary, and given electricity is trimmed out of the core measures, most of the price series came in broadly as expected. For some background, here is a closer look at some of the key categories. Rents were up 0.2% in October, same as they were in September. Excluding rental assistance, both months would have been at 0.3%. New dwellings, up 0.4%, exactly as we expected, so no effect on our forecasts. Electricity fell 10.2%, much larger than our forecast of a 6% fall, so impacting on our forecasts. Holiday travel, it was down 1%, dragged down by international travel falling 7.9%, partially offset by domestic travel up 5.9%. Garments, this surprise with an upside measure of 2.6% compared to our expectations for a flat print. Household contents and services up 0.7% against our expectations for a small fall. So while the October CPI surprised the market, it didn't surprise us. As such, we see little reason to change our inflation forecasts and therefore no reason to change our view that the RBA will be cutting interest rates next year. As always, we'll be watching the data closely. Stay tuned for our next update.